We have to begin with this bounce that we're seeing in mainland China and in Hong Kong. More stimulus pledges from authorities here and perhaps even a commitment from the leadership that they will address this. So characterize it for me. Do you think this is a dead cat bounce perhaps?
Yeah, I'm hoping that it can at least last until Friday when the Chinese New Year holidays begin. But I think, like you guys were saying, is this sustainable post Chinese New Year? And I think they're still in a very tough position, and mostly because they have to sort of choose between the stock market and the foreign exchange market. And the foreign exchange market takes priority because it can destabilize the entire system. And that one is being under pressure from this higher U.S. interest rates and the higher data that you're seeing from the U.S. So I think the Chinese authorities are really hoping that the next week, the U.S. CPI numbers, these things come in a lot lower so that U.S. rates come down and puts less pressure on their currency.
So just to stress test it, would you be a buyer of Chinese or Hong Kong stocks in this environment right here, right now, today?
Yeah, I think it's way too early. You do need to see the Fed signaling the interest rate cuts are coming imminently. I think when you get those U.S. interest rates coming down, it should really help not just the Chinese economy, especially something like the Hong Kong market, where the peg means that lower U.S. interest rates leads to lower Hong Kong interest rates.
Yeah, absolutely fair. And I think we need to wait and see what the leadership says about the market management strategy moving forward. Sean, let's focus in on another key area of the market today. We've just seen the RBA keeping rates on hold as expected, but Michelle Bullock guiding the central bank through its first ever press conference. What did we learn from what she said about the outlook? And most importantly, what do you see as the wider implications of this strategy review that the RBA is now implementing?
Yeah, I think in terms of how they've shifted, I think they have shifted more to what other developed central banks are doing. So I think they're moving more towards the norm. So it shouldn't be such a big deal. But I think Australia stands out because they are still one of the central banks that they have a neutral policy, which means interest rates can either move up or down next, whereas the others are all signaling an easing. So I think in that environment, Australia should outperform relative to other currencies.
Okay, watching that closely. And, speaking of where rates go next, focusing in on the United States, because it was only a few weeks ago that we were talking about the prospects of March being a live meeting. It seems as if markets have now cooled down expectations. We've seen Fed Chair Jay Powell also throwing cold water on that idea. But where would you say the central bank is right now? Are we really seeing Chair Powell align the Fed into a neutral stance rather than an easing bias?
Yeah, I think we're still a little bit away from that. And in order for the Fed to move to neutral, which means they could either hike or cut rates, I think they will have to focus on next week's inflation numbers. So inflation's been running around 0.3% month on month. But if that reaccelerates up to 0.4, which is what we saw earlier last year, I think that kind of move is what's needed for the Fed to move back to a neutral stance. But I think it's a bit of a tall order to do right now. So for SEB, we still think that, yes, it's more towards May or June that they eventually have to start cutting rates.
One of the things that has been suggested to me in the last couple of days is that we are seeing the interest rate cuts already being priced into markets, which explains some of the outperformance that we've seen from the Magnificent Seven and other pockets of US equities as well. What's your view? Do you think that we are perhaps vulnerable for a correction now in the United States, given the outperformance of some of these stocks off the back of the realignment in interest rates that we're seeing?
Yeah, that's a really good point because the main drivers of equity since November when the rally started has been this one, interest rate cut expectations. And second thing was the positioning. Positioning in long equity was very low. But 3 months later, where we are now, positioning is already relatively high. People are already long stocks. And then we're not going to get that extra push for interest rate cuts.